Welcome to the Capital Spreads Weekly Update. Today is Wednesday, the 21st of July 2010. And the week so far, well, mixed bag seems to be the key word of the day. For example, we had the mixed bag of corporate earnings at the US of the last week, with a number of companies far exceeding analyst expectations, while other companies have fallen far short. We've also had a mixed bag of sovereign data of the last week. For example, Ireland got downgraded on Monday. Hungary had a failure of its bond auction yesterday, but we had strong demand for bond auctions out of Greece, Spain, as well as Ireland. Investors are currently waiting for the results of the EU bank stress tests, which test the strength of 91 Eurozone banks and check to see whether they could cope with and manage another credit crisis type situation that we've had over the last year and a half or so. So the situation as it currently stands, the FTSE is currently trading around 5,200. It's about flat on the day. It broke through its 200-day moving average back on the 25th of May, a level I've previously mentioned on one of my previous posts. And the 200-day moving average has been acting very much as a resistance level ever since. Most recently, when the FTSE had a rally up to 5,300, the 200-day moving average was the level of which it actually bounced and reversed from there. The FTSE is currently ranging between about 4,800 and 5,300, and that certainly doesn't seem to look like it's going to be changing anytime soon, with continually changing and mixed economic as well as financial data around the globe. We have a change in economic sentiment almost on a daily basis, and until we get any clarity either way, that it certainly looks like the FTSE will continue to range. The euro has had a strong rally up over the last week or so. It's currently trading on 128.90. It hit a high of 130.30. Now this was very much off the back of the belief that none of the Eurozone countries will possibly default, at least in the short to medium term, especially considering the strong demand that we've had for the bond auctions out of Spain, Ireland as well as Greece yesterday. However, that's not to say that the problems in the Eurozone have gone away. They just seem to have been pushed further into the future. The euro seems to be very much in a strong trend at the moment, and that doesn't look like it's going to be reversing anytime soon. So if it continues on its current path, you could possibly see euro going through 130.00 and possibly even up to high as about 131.20, which is the 38% Fibonacci retracement level for euro dollar. However, it has to also be kept in mind that 130.00 is quite a strong psychological level, so if it doesn't break through 130.00, you might possibly see euro dollar going back down to 127.00 instead. Gold seems to have found a bit of a range at the moment. It's currently trading around 11.90. It seems to be ranging between about 11.75 and 12.20. Now, we had a bit of a rally yesterday, which was very much a flight to safety effectively, because we had quite negative results coming out of the US, as well as mixed corporate earnings, and the fact that there's still a lot of uncertainty in terms of where the global economy will be going forward. And as a result of that, many people have been buying into the gold over the last day or so. However, in the short to medium term, you could probably see the gold continue to range between 11.75 and 12.20, and that won't really change until the global outlook becomes a little bit clearer. Oil too seems to have found a bit of a range at the moment. It's currently trading around 77.80. The range it's trading is currently between 75.00 and 80.00. Again, it's very much reflecting the demand and the changing sentiment in global demand for oil on an almost daily and almost weekly basis, and that again doesn't seem to be changing. For example, you'll have negative news one day, positive the other, and that gets priced into oil pretty much on a daily basis, resulting in the ranging markets that we're currently having at the moment. In my opinion, that too won't be changing anytime soon. In terms of looking at the week going forward, we've got a number of figures over the next couple of days which could certainly move the markets. One of the first ones to look out for will be the oil inventory figures coming out later today. Now, we're expecting a small drop in oil inventories later on today, which could possibly see a further rise in oil prices. However, this has to also be balanced by the fact that, again, certain other countries around the world seem to be showing that they're possibly slowing down, so demand from those countries might actually reduce, which again will only lead to oil continue to range trade. We've also got UK retail sales figures coming out tomorrow, as well as the more important GDP figure at the UK on Friday. Now again, both of those are expected to show a small decline. However, any large deviation from a small move either way from those two figures will certainly move the markets quite strongly in the UK. In terms of client activity, many of our clients have been fading the strong rallies we've had in the indices markets over the last few days or so. For example, they short the Dow, the S&P, the FTSE as well as the DAX. They continue to hold long positions in a number of the commodities, for example gold as well as oil, which seem to be very long-term positions that they've had for many months now. At the same time, they've started to sell into the rally we've had in Eurodollar at the moment. So many of our clients sold from 129.00 up to about 130.00 and holding on to short positions as it currently stands. In terms of a theme of the week, I think the theme of the week would very much be how economic sentiment seems to be pushed around by the mixed bag of results and the changing economic news and economic sentiment on an almost daily basis. Now this is being driven by the fact that you're getting mixed economic results out of the US. For example, Apple came out with exceptionally good results, and then you had that being balanced by IBM missing the results quite badly, as well as Goldman Sachs missing the results quite badly. You've got mixed sovereign data, for example, as I mentioned, the downgrade of Ireland. At the same time, this has been balanced by a more positive outlook out of Asia and China, for example. Now, this is all creating a lot of uncertainty in terms of where the global economy will be going forward, and it's making it very difficult to place long-term positions and long-term bets. That's it for now. As usual, if you have any feedback, it's media@capitalspreads.com.